Some investors constantly feel the need to act, but acting usually results in worse outcomes. That's right. In most cases, the best course of action is inaction. Financial markets are always changing, and so too are the forces behind that constant change. Market sentiment, consumer trends, economic factors, and political events, for example. But as Joe Wiggins explains, that doesn't mean we should be forever changing our investment strategy.
That's the instinct, and that's what we tend to think we need to do, but that's the exact opposite of what we should be doing. So because financial markets are volatile and chaotic and unpredictable, we feel like we need to change our portfolio. Things are changing, my portfolio needs to change and adapt to reflect that. That's exactly the wrong route to take. We should be saying we cannot predict these things, we just have to accept it as a feature of financial markets, and therefore being stable, being consistent is much more important, and avoiding that urge to continually act can be incredibly beneficial through time.
When we make decisions, there is a constant tension between the right thing to do or the sensible thing to do and the thing that feels emotionally comfortable for me in the moment. And action bias is an example of that. When we are putting a large chunk of our hard-earned wealth into the markets, sitting and doing nothing after that, particularly as we observe the political environment changing and the economic environment changing, sitting and doing nothing makes us feel very often very uncomfortable because we feel we should be doing something.
So why does this compulsion to act have such a negative impact on investment returns? Here's Joe again.
So there's just too much activity and trading in portfolios, and there are two problems with that. One is that there's just the frictional cost of that constant trading. And the second part, which is even more pernicious, is we will be wrong a lot when we're doing that. And there's this negative compounding from those types of mistakes we make through time. Again, these things tend to make us feel good. It makes us feel good to make changes and adapt our portfolio to whatever we presume the current market conditions are, but we're very, very likely to make really poor decisions in doing that compound negatively over time.
Most of the time, doing less is a good thing to do, simply because as humans, our ability to predict what's going to happen next is very, very weak. And if we start to constantly trade in and out of things where we don't actually know whether it's going to go up or down in the next week or month, we're incurring lots of transaction costs and we run a grave risk of getting it wrong.
In 2023, Morningstar looked at how what it called a do-nothing portfolio would have performed over the previous 30 years. Its findings were extraordinary.
Essentially what I wanted to understand is if you invested in the market, but you just did nothing, like nothing, what would have happened? And so to test that, what I did was I looked at the S&P 500's constituent holdings, and what I did was I froze them. So you would have, the top constituents that have certain weights that were accorded to them at that time. And so you basically would build a portfolio to mirror that, weighting the constituents according to what the S&P weights were then. But you would do nothing thereafter. What we found is that strategy performed about as well as the actual S&P from a return standpoint, but was meaningfully less volatile. And so the risk-adjusted returns of this do-nothing strategy were better than the S&Ps. And the S&P has been a very, very difficult beat over the past decade or so, as I think has been well chronicled at this point. So the fact that you could have beaten it by doing nothing, we found interesting.
But it's not just ordinary investors who suffer from action bias. In many ways, the pressure on professional investors to act is even greater because it's seen as part of their job to be doing something.
There's this great study into action bias that looks at goalkeeper behaviour during penalty shootouts. And the evidence is that goalkeepers are better off just standing still and doing nothing. And they know this, but they tend to dive left or right. And when asked why they do that, it's because they say, if it goes into my left or right and I didn't dive, it will look like I didn't even try. So even though I know the optimal thing to do is to just stand there, is not optimal in terms of the perception of what I'm doing. And that's the same for investors. On any quarterly basis, they'll be asked, what have you done this quarter? What changes have you made? Why haven't you been doing anything?
There's a constant pressure to look as though we're doing something, either to others or to ourselves. And that is exhibited in a whole lot of issues in our lives, but particularly when the markets are going through turmoil. We know that logically the best thing is to stand in the middle. The best thing is just to sit tight and wait it out and do nothing, partly because trying to predict things in the short term is a bit of a crapshoot. So just sit tight and do nothing, whereas what we're constantly tempted to do is to jump left or jump right, is to make these changes to our portfolios.
Something that compounds the negative impact of action bias is technology. It's never been easier to check our investments or to place a trade than it is today. So what's the answer? Well, one of the best things you can do is to find an advisor who understands that doing nothing is usually better than doing something just for the sake of it.
95 times out of 100, doing nothing is the right thing to do. And that's one of the things that's how we do as an advisor, because people are paying you to invest. If you're not trading a lot, people will ask you, well, why aren't you working hard? Why aren't you trading? And the answer that you have to give them is because that's the best thing for you. And it's the best thing I can do to fulfill my fiduciary responsibility to you, is to do nothing 95% of the time.
We need to shift the defaults. So rather than thinking, why haven't we done anything? What have you done over the last month or the last quarter? We should be thinking, why have you done something? Why have you diverged from our long-term plan?
But what if you really feel you have to act? Well, there may be a compromise solution.
I had a conversation with an advisor in the US many years ago after the financial crisis. And this advisor said to me, he said, if I tell my clients to do nothing, it makes it worse. It makes them more stressed. It makes them more anxious because they don't like doing nothing. So what I do is I come up with a list of fairly rudimentary housekeeping tasks to do on the portfolio. Small things they can change, a bit of rebalancing here, reduce this here. Things that are going to make genuinely very little difference to the portfolio in the long run. But it gave them the sense that they were doing something rather than nothing. So often with a lot of these biases, trying to turn off the bias is really, really difficult. And if we can find ways of assuaging our emotional need for action without reaching for the sledgehammer actions of sell everything or double down or leverage or whatever, doing a bunch of small things, using periods of trauma and turmoil to do housekeeping on your portfolio when you're naturally engaged on it is actually a good thing.
To summarise then, find an advisor who understands the value of inaction, or at least doing less. Make doing nothing your default strategy. If you still feel compelled to act, keep any changes you make to an absolute minimum. Don't just do something, stand there. You'll almost certainly achieve better returns if you do.